Trump officially returns to the White House this upcoming week, and the world is holding its breath to see whether he will see through and to what extent his tariff threats. It's the week ahead at exam.com. Thanks for joining us. I'm Christina Marujos, and with me today is our senior market analyst, Haralambos Pissouros. So Haralambos, Inauguration Day is almost here. On Monday, the United States will see Donald Trump taking office again. How might this event affect money markets?
Hello, Christina. Yes, indeed, investors seem to be eagerly awaiting Trump's inauguration, and this is evident by the fact that the implied volatility of the one-week expiry FX options has been in an upward trajectory recently and continued to rise even after factoring in the event. In other words, market participants expect volatility. Now, the US dollar has been already benefiting, and treasury yields have been rising lately on increasing expectations that the Fed may proceed cautiously with rate cuts this year. Trump's tariff and tax plans have raised concerns about the resurgence of inflation, which has already been proving sticky even before such policies are enacted. Now, the robust performance of the overall US economy is also suggesting that there is no need for the Fed to rush into lowering interest rates. Investors are currently expecting fewer basis points worth of rate cuts this year than the 2-quarter point reductions projected by the Fed, and this is even after headlines pointed that Trump is likely to proceed gradually with tariffs, and also after data showed that US inflation was somewhat softer than expected in December. Therefore, should Trump sound more hawkish on tariffs than the latest headlines suggest, the dollar is likely to take another shot in the arm as treasury yields rebound. Now, a potentially risk-averse mood could also weigh on Wall Street, but where stocks will finish the day is not so straightforward, as any remarks bolstering the hype about corporate tax cuts could very well prove supportive for stocks.
Now let's turn to the central bank front. The Bank of Japan meets on Friday as policymakers increase their hawkish rhetoric lately. Could we see the BoJ delivering the much-discussed rate hike this week?
Yes, there is a strong 80% chance of that to happen, according to market pricing, as since the latest Bank of Japan decision, inflation accelerated in November, with the Tokyo prints for December pointing to more stickiness. What's more, Ueda himself said very recently that he heard many encouraging views on potentially pay hikes since the turn of the year. And let's not forget that after the latest decision, Governor Ueda placed extra emphasis on wages. But he also placed emphasis on the uncertainty surrounding Trump's economic policies. So, having said all that, the Bank of Japan has a strong record of disappointing hawkish market expectations, and this may be another one of those occasions if Trump sounds too aggressive about tariffs on Monday. Now, if the bank remains on hold, the yen is likely to tumble, while the opposite may be true if we indeed get the much-awaited hike. However, in the first case, a falling yen may not be the easiest trade in town, as further declines may encourage a new round of intervention by Japanese authorities.
I see. Now let's turn to the data front. We'll be getting important CPI data from Canada and New Zealand this upcoming week. What could these reports mean for the Loonie and the Kiwi?
In Canada, the jobs report for December came in strong, but still investors are assigning a decent 65% for the Bank of Canada to cut interest rates by another 25 basis points at its upcoming gathering. For that percentage to be lowered meaningfully, Canada's CPI numbers may need to come hotter than expected, which could encourage Loonie traders to increase their long positions. Now, in New Zealand, there is a strong 85% chance for another 50 basis points reduction, and this is with inflation resting at 2.2% year on year, very close to the midpoint of the bank's 1 to 3% target range. So, should next week's data reveal that inflation returned or even fell below the 2% midpoint, market participants may even start considering a larger 75 basis points reduction, and therefore the Kiwi may resume its prevailing steep downtrend.
And before I let you go, Haralambos, let's look at another important event this upcoming week holds. The World Economic Forum is taking place in Davos, Switzerland, and it will be interesting, I think, to see what kind of risks global leaders are projecting for this year. So could we see any significant moves in the markets on the back of this?
Yes, I think we could get some market-moving headlines as global leaders may well raise their concerns about the geopolitical tensions around the globe, also mention the economic risks of those tensions, and perhaps call for unity. Their views on Trump's agenda may be closely monitored as well, while artificial intelligence, I believe, will also have a special place on the agenda.
I see. Haralambos, thanks so much. This was The Week Ahead here at XM.com.